Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Canada has reached a new trade deal with China. Prime Minister Mark Carney says Canadian tariffs on Chinese EVs have been eased in exchange for reduced levies on canola exports set to take effect on March 1st. The announcement comes after Carney met with Chinese President Xi Jinping looking to reset trade relations. Housing starts picked up across the country at the end of last year. Data from the Canada Mortgage and Housing Corporation shows the number of homes being built came in at an annualized rate of a little more than 280,000 units in December. That marks an 11% increase compared to the month before. Ontario, Montreal, and Vancouver logged the highest increases. Activity had been soft toward the end of last year as the sector dealt with economic uncertainty. We're watching shares of First Quantum Minerals today. The Canadian miner says the Panamanian government has authorized the removal and processing of certain materials at the Cobre Panama copper mine. First Quantum says the move marks a positive step, but does not constitute a reopening of the mine. Panama took control of the mine back in 2023. And looking at the markets, off a little bit today, down below 33,000, which was a record high yesterday. You can see it's up by about 0.19%, but still for the year up nearly 4%. Heading south of the border and up and down right now. You can see S&P 500 pretty much awash. It was flirting with 7,000, still is. And the Dow Jones down by 0.16%, and the NASDAQ is off minimal, almost a wash there as well. We are watching for more news coming out of Beijing today after Prime Minister Mark Carney announced Canada and China have reached new trade deals. BNN Bloomberg's Lindsay Biscaya joins us now with the latest. And what a day. We expected something.
What a week.
Really. I don't know if anybody expected this, though.
I'm not sure if anyone did. There was some talk that this is kind of what China wanted going into these meetings. There was reports that they were going to ask for this, but we're seeing this, and it's pretty incredible to see really Canada and China meeting a bit of a middle ground here. And this should unlock about $3 billion worth of exports for Canada. So in terms of the details, what we know now is China will drop tariffs on canola seed coming from Canada to 15%. Earlier, it was at about 80 to 84%. Canola meal, lobsters, crab, and peas will no longer be tariffed. And this is supposed to start March 1st and then last until the end of this year, which is something Scotiabank economists had picked up on. They sent out an analysis this morning saying that leads some uncertainty in terms of what happens after this year. And it's not clear at this point why.
The EVs are a different deal.
Yeah, the EVs are a different deal, and just also no mention on canola oils. That's canola seed where the tariffs are going to be dropped. Canola oil was tariffed at 100%, and there's no mention on that. But yes, in return, Canada will ease tariffs on electric vehicles. So they will allow 49,000 Chinese-made electric vehicles into the Canadian market every year at a tariff rate of 6.1%. Before it was 100%. And, Carney says this number allowed in is about the same that they allowed in from China back in 2023. When you think about it, 49,000 vehicles isn't a lot considering about 1.9 million vehicles are sold in Canada every year. But we are hearing concerns this morning that this could do something to the Canadian auto market. But Mark Carney trying to stifle those concerns, saying that it's less than 3% of the Canadian auto market. But it could open up a window in the future in terms of electric vehicles and Canadians have more choice now.
Yeah. And these Chinese EVs are noticeably cheaper, too.
They're noticeably cheaper, and that is the main point. And we were speaking with William Pellerin earlier today about that fact. And here's more on what he had to say.
I think that some will view it, certainly in the auto sector, as potentially the start of something. If Canadian consumers start loving these vehicles and it kind of changes the outlook on the Chinese electric vehicles at low prices and good quality vehicles, then that could be potentially the start of something new in the Canadian market. But I think the hope generally is that the Chinese producers over time will set up facilities in Canada, that the Chinese electric vehicle battery ecosystem will move to Canada to some degree and create Canadian jobs here. And I think that's the long-term play.
And that's something we heard from Mark Carney as well today when he was asked about, what is this going to do to the Canadian auto market? He said he's hoping for partnerships in the future with China.
All right. Leaves a lot of things open. Yes. What kind of response are we seeing on the markets?
Yeah, it's interesting what we saw in terms of canola futures this morning. So before the bell, canola futures were rising by about 2.6%. That's the highest we've seen them go up since December. They've dropped a little bit since then. But, there is some hope now, particularly for Atlantic and Western provinces, that this opens the canola market back up. Canola farmers have been hit incredibly hard by these tariffs that we've seen from China over the last couple of years. So canola futures are rising. And then, of course, other reaction that we're waiting for that could move the markets, as it sometimes does, is reaction from the White House.
Who's been remarkably quiet.
Yes.
I would have thought right away.
Yeah, exactly. And a lot of economists and analysts that we're speaking with today are saying that they're not going to like this news. Of course, especially when you're speaking about EVs and the tariffs. The U.S. pressured Canada in the first place to put 100% tariffs on Chinese-made electric vehicles. So we're watching for that. Still nothing yet.
All right. This is week 2 of January.
Yeah, I know.
Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Now, for his take on the China-Canada trade deal, we spoke with Lawrence Steinberg, the co-president at Lawrence Steinberg Wealth Management, for his thoughts on this developing story.
He needs to cut a deal with China and not be under the foot of the U.S. with everything. I think this is probably a pretty good deal. We're allowing very few EVs to come in, and it's a great deal for canola farmers that have been under tremendous pressure. I think Carney's done a reasonably good job here, but there was really no option.
Now, I mean, there's still a tariff on the canola, but it's one they can work with, right? 15%, I think, is what it drops down to.
It's down to a more normalized level.
And did we give up the farm, so to speak, for anything here? Does it feel like, or
I don't think so.
That was my concern, because it doesn't feel like we're necessarily negotiating from a position of power.
We're not
anywhere.
Exactly, and so allowing a small number of EVs is not going to make the Canadian auto sector happy at all. It's not going to make Ford happy at all. But I think it's a pretty small thing to trade to just get back on having good relations with China, and leveraging that relationship, hopefully a little bit with the U.S. to show that we have options, and also showing Canadian industry that we're going to stand up for Canadians and for jobs as well, which is critical, and not just give everything away. We can't afford to play hardball with anybody.
And how do you think Canadians are going to react to these EVs? Will they look at them and purchase them if they're available?
There is such a small number that will be allowed to come in that I suspect there's enough of the population that will buy them. They're coming in at very, very cheap prices. They'll be way cheaper. In fact, it's the lower priced EVs that'll be the beneficiaries, so the $35,000 EV. And so I suspect they'll probably fly off the shelves.
Yeah, and as they lower they're kind of lowering the tariffs as we go to a degree. With some of them will be down. I thought I saw 25,000.
Exactly. So like I said, I think they'll fly off the shelves. There's so few of them coming in that there will be enough Canadians that won't care, make a judgment
elbows
call
up or not,
China.
It won't matter.
Exactly.
And with the canola, is a lot of this what we're seeing with this deal? Is it a bit of symbolism, really? Because there wasn't really much movement happening with the EVs. And the canola, I mean, China, I think, needs the canola. And so everything we've got it down to a place that we kind of were before all.
First of all, of course, there's a lot of symbolism, especially with China. But it does seem to reset the relationship. And for China, the face saving and everything else is a huge issue. And they want Canada to look at them as unlike the U.S., not as an enemy, as a friend. And so that's a huge part of this, but I think Canada basically needs it because we don't have much choice.
Does this open up a path for oil going that way as well?
I think it opens up a path for energy investment, which we could probably use. Oil prices are depressed, and I don't think this deal is going to change very much that way in terms of how we're, getting oil over there. I don't think it's going to have a huge impact in the near term on anything to do with Canadian energy prices.
All right, and now the elephant in the room. He has not gone on Truth Social yet. Donald Trump has not responded yet, which kind of surprises me. I thought we might have heard something from him already.
And I think it just hasn't possibly happened yet.
Nobody wanted to wait.
We're all waiting. We're all waiting for the other shoe to drop. But the U.S. cannot be happy at all with the deal and with the press conference.
Okay, and What kind of an impact, quickly before we go to break, what kind of an impact do you see this having on the Kuzma negotiations?
I don't think it's going to have any significant impact because that's still a few months away. And I'll tell you the best thing in Canada's favor with that is that the U.S. auto sector and many other manufacturers are aggressively lobbying U.S. policymakers to keep the U.S. the Kuzma because they're the ones who are going to get hurt. It's going to kill the U.S. auto sector. It's going to cost them tens of billions of dollars if they had to actually make cars there. Cars are more expensive, so I don't think it's going to have a big impact.
And that was Lauren Steinberg, co-president of Lauren Steinberg Wealth Management. Up next, we'll turn to the latest in the U.S. markets for more on what's happening there. Our focus has been on the deals with China, but let's take a look at the U.S. markets and how things are shaping up down there. And our next guest sees that while overall U.S. unemployment rates fell, the majority of the decline was due to increased retirements and recovery in government jobs. Let's get more on this and the latest in the markets with Michael Green, Chief Investment Strategist at Simplify Asset Management. Michael, thank you, as always, for joining us.
It's a pleasure to be here. Thank you for having me.
So you're a little worried about those employment numbers.
I am a little bit worried about the direction that the employment is going. In particular, we're seeing the college-educated individuals in the United States are experiencing very high levels of unemployment relative to their own history. That is really going to be the key component that colors a lot of what happens over the next couple of months, whether the Trump policy plan to effectively reshore large elements of trade to invest in capital in the United States, where we have significant infrastructure and in particular energy needs, that is starting to pick up. And we are starting to see signs that that is having an impact in various sectors. At the same time, we are seeing government slow down significantly in terms of expenditures and hiring. The states are under increasing pressure, as we're seeing with California threatening to increase a wealth tax. And I think broadly speaking, the general concern in the economy from voters is largely about employment, much less about things like China, which I know you've been talking quite a bit about.
Now, we did see the industrial production jump 0.4% for December, but one Bloomberg economist say it actually reveals weaknesses below the surface. Your thoughts on that number?
Well, I think that's actually exactly the right way to think about it. We are definitely seeing, particularly in electricity production and in the utility sector, that increased demand from power coming from data centers is driving investment. It is capturing the attention of the administration here in the United States. Donald Trump has announced that the AI companies and data centers are ultimately going to have to fund their own power contracts by signing effectively debt agreements, take or pay power contracts for extended period of time. If you're OpenAI, for example, without a publicly traded security or significant debt outstanding, that could prove challenging. Ultimately, it means it's going to rely on the independent power producers in the United States to produce additional power at basically today's prices, exposing risks across a couple of components. But that is really the only area that we're seeing significant growth in the United States. And it remains a key question whether that will translate to significant productivity increases and the ability of the United States to effectively restructure itself away from largely financialization towards actual production, development, et cetera.
And I mean, America was a production giant, and it still is. Do they have the ability to ramp that up, do you think?
I think the United States does, and candidly, I heard your earlier conversations about Canada and the recent trade agreement with China. I think what is happening in Canada, this plan that has been announced by Carney, it effectively establishes him in opposition to Trump, which plays well to a populist base. At the same time, he's further cementing Canada's trajectory that the United States unfortunately adopted in 2000 when the China shock ultimately hit. There's effectively a de-skilling that's going on within Canada's exports, where you're emphasizing agriculture and effectively a ceding that your complex auto industry is up for sale. That's gonna create many of the same challenges in Canada that the United States has had to absorb for years. We've seen a deindustrialization in our trade policy. Some of that is because the United States is a very expensive place to do it. Others were strictly choice. And, I think Carney, unfortunately, is making some poor choices right now.
What do you think? What kind of a reaction do you think we'll hear? I mean, I'm surprised we haven't heard anything yet from the president on this, but does this play into his wanting to bring manufacturing back home? And what do you think, or do you think, and he'll be actually happy with this move, or is he going to be upset with it?
I think, unfortunately, there's two components to it. One is if you expect a reaction and you expect somebody to be angry, remember, revenge is a dish best served cold. The fact that Trump hasn't responded suggests to me that they're taking this very, very seriously. The second component that I would emphasize is, unfortunately, we would love to have Canada as a strong partner of the United States. It does play very well to be viewed in opposition to Trump. He's a polarizing figure. I object to many of the ways that he presents things, but at the end of the day, he is in many ways representing both the national security interests and economic interests of most Americans when he focuses on this, and that is the job he is elected to do. Again, I think Canada is making a short-sighted choice both in economic development and in political relations, but I understand why it's happening. And unfortunately, I think ultimately the response from the administration is going to be a combination of, well, we gave you an opportunity and therefore we're going to effectively put in 232s and potentially challenge even NAFTA itself. That would be really catastrophic for Canada if that's the posture that the United States government chooses to take.
But can Canada? What should they do? Should they just roll over, or do they have to present a stance? Does Trump like a challenge and respect that, or should Canada be rolling over and taking whatever is offered to them?
What I would love to see is Canada actually presenting a principled adoption and understanding of this. There are many, many ways that the United States, as I said, would like to work with Canada, whether it's in the energy sector, the agriculture sector, and candidly in the manufacturing sector. The ability to friendshore many of the activities that are happening elsewhere is certainly something up for grabs. I can't tell you exactly how Trump is going to respond to this. I'm certainly not the man himself, and nor do I have a direct line to him. But this does feel like it's much more about personalities than it does about economic rationale. At the end of the day, Canada is very, very closely linked to the United States, both in terms of market integration and geography. It doesn't make a lot of sense to choose allies that are on foreign soil across an ocean. And that have expressed significant opposition. At the end of the day, Canada wants to produce and sell products, and they want to consume products that are valuable and relevant to the Canadian population. Right. There is no empire that has a production center like China at the center of it. Rome does not ship its goods to Persia. It ultimately imports things because it is done more cheaply in foreign provinces. Canada, in many ways, represents the exact same phenomenon as we had within the Roman Empire, and really should focus on aligning itself much more with the United States.
All right, I have to wrap it up there. I would love to continue this conversation, but Michael, thank you very much for joining us.
Thank you for having me.
Michael Green, Chief Investment Strategist at Simplify Asset Management. Coming up, we're watching the price of oil after a turbulent week as geopolitical tensions continue to ripple through global energy markets. More on that when we come back. Oil edged higher today following a volatile week. Ongoing protests in Iran as well. They've all disrupted oil production, and then there's shipping adding pressure to prices amid heightened market uncertainty. For more on this, we were joined earlier by Jeremy McRae, Managing Director in Energy Research at BMO Capital Markets.
We got from one geopolitical event to another here, from Venezuela to Iran. As you head into the weekend here, there's other concerns of what goes on the weekend. And it's a lot of just concern and nervousness out there right now with the market.
Okay, what concerns do you have for this weekend?
So Iran never really looked like it solves the full issue here. I think the immediate reaction was what could potentially happen. There's not really a lot of precedent here in terms of how big things could be. But if you look back to 2020, that's when sanctions brought off about 1.9 million barrels of oil. So I think that's what a lot of the oil traders were thinking about is, do we get to that type of scenario? What is the possible ramifications of what could potentially happen here on the weekend?
Jeremy, let me ask you a question. When you look at the actual fundamentals of supply and demand in the oil market, what do you see?
So you got disagreeing opinions here with a few of the bigger organizations, and not so much it's how investors perceive these different perceptions. So you have the EIA who just came out with their forecast here, and you're still growing at 1.2% into 2027. But the amount of OPEC production that is looking to come on really pushes onshore inventories to levels not seen since effectively COVID. But then when you look at the OPEC is expectations for demand here for 2026 and 2027, it's quite a bit above EIA. And so that's why OPEC is producing as much as they are, saying we need to keep a balanced market to match the demand that we're expecting here. And so this is where you get these fundamental differences in opinion and why there's a lot of unease in terms of what we actually could see for the oil markets here for 2026 and 2027, just given such big differences in expectations.
And what are your thoughts on those two? Which one is there one or the other you're leaning toward?
I tell you, so if you look back at history, the EIA tends to be middle of the road. OPEC tends to be a little bit more optimistic, and the IEA tends to be pretty bearish, and that's generally what we see. And we ultimately, halfway through the year, things start to coalesce into a single number here. But this is probably one of the wider ranges we've seen in terms of the forecast between the two, and I think that's what's causing a lot of the concern here with investors that we talk to is who is right, who is going to be adjusting. And I think what it comes down to is investors are saying, well, if the demand isn't that high, OPEC likely does cut, and that does likely put a bottom here. When you look at how economic a lot of the new plays and new drilling is at these levels here, it really is starting to get to that real marginal level. And so I think you are ultimately we're going to see some production declines coming from non-OPEC countries here, which ultimately should put a support into where we are seeing with oil prices here today. But that said, when does that happen is a little bit more concerning, especially when you add in all these geopolitical events for investors.
And when you look at the sector in general, can you talk about valuations and what you like?
So when you look at the commodity price here today, relative to valuations, it's higher than what we've seen before. But when you look at other sectors, though, energy is still seen as reasonable, relative to everything else. And so that's why you're seeing some more inbounds in terms of, maybe we got to look at energy here, and we haven't been involved in energy for a while. We are seeing more investors look at natural gas type of names here versus oil, not wanting to play a lot of the volatility. But what we've always told clients in this type of market, it's best to just stay safe here. So you look at royalty names. So Topaz and Prairie Sky would be two names we would highlight, but then also names that have a cash balance that are also in top tier play. So this is where the Clearwater operators look. Headwater is one of the pure play companies in there with a cash balance. So these are some of the few names that we would highlight here with investors who are looking for a way to play the bridge into higher oil prices without taking on a lot of excess risk where the commodity price is today.
And are we starting to get a better feel for what's the impact of Venezuela with Canada? And I guess this deal with China today, does that play into where oil might end up going from Alberta? It's
funny, like every day there's a new headline here that makes investors bullish or concerned here. And so I think there's a lot of information coming out of Venezuela, and everyone's suddenly trying to become an expert here, saying, how realistic can we increase Venezuelan oil? And I don't think the reality is anybody really knows. It does sound like there's probably a couple 100,000 barrels that could come on much more quicker, and that's what's leading to the heavy oil differential widening a couple dollars here over the last week. But it's hard to see how much. It's not so much the near term; it's the expectation for growth coming out of Canada, what's the growth coming out of Venezuela, and these are knowns but unknown in terms of how quickly can this all come out. And that's what's causing some apprehension just with investors here in terms of when do we get involved and how big could this really be here in terms of the blowout that we could see for heavy oil. I don't think it's going to be as nearly as dire as everyone likely thinks. But, this is talking about a year, 2 years from now. And I'm echoing some of the words that Exxon had, just a few days ago here.
Mm-hmm. That's Jeremy McCrae, Managing Director in Energy Research at BMO Capital Markets. Still ahead, we'll continue our coverage of Canada and China moving closer together and strengthening trade ties. Well, Canada has reached a new trade deal with China. Prime Minister Mark Carney says Canadian tariffs on Chinese EVs have been eased in exchange for reduced levies on canola exports. Some canola exports set to take effect March 1st. The announcement comes after Carney met with Chinese President Xi Jinping, and they are looking, of course, to reset trade relations which have been strained.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
Not everyone is happy with this. Ontario Premier Doug Ford condemning Prime Minister Carney's deal with China. Ford says the agreement gives Beijing a foothold in the Canadian market and will be at the expense of Canadian workers. In a statement, Ford highlighted that Ottawa is inviting a flood of cheap made-in-China electric vehicles without any real guarantee of equal or immediate investments in Canada, the auto sector, or even the supply chain. Housing starts picked up across the country at the end of last year. Data from the Canada Mortgage and Housing Corporation shows the number of homes being built came in at an annualized rate of about 280,000 units in December. That marks an 11% increase over the month before. Montreal and Vancouver logging two of the highest increases. Activity had been soft toward the end of last year as the sector dealt with economic uncertainty. And looking at the markets, bit of a yo-yo day. The TSX still in the green right now, but just barely, almost a wash right now, but above 33,000, hovering around record territory. South of the border, which way are they going now? Okay, they're on the plus side now, but barely right now. The S&P 500 is looking at 7,000 again. It's up by 0.13%. The Dow is a wash, and the NASDAQ is up slightly. Well, Prime Minister Carney reached a deal with China to slash tariffs on a set number of Chinese EV vehicles in exchange for China dropping duties on agricultural products. For his take on this, let's bring in Derek Young, partner at Gowlings. Derek, thanks as always for joining us.
Thank you, Roger, for having me.
Your thoughts on the deal? I mean, I think a lot of people were surprised. Your thoughts? Did you expect something like this to come down the pipe?
Well, I think it's one of those things where I think most analysts were expecting some deal to come with these discussions. I think there was a lot of expectation that any deal would be structured and implemented in a fashion that was gradual. So it wasn't something that necessarily, I think, reflected a major policy shift. What we're looking at is the gradual implementation of a deal that allows the Chinese EV manufacturers to be in this marketplace, while concurrently we gain access in terms of agricultural products, particularly canola, to a very large Chinese market. So I think on the balance, this is largely what was expected from these discussions.
And now, as we get some more details on it, I mean, we're seeing canola oil is not part of this. The tariff on canolas would end at the end of the year, yet the EVs, there's no end date. It's I looked evergreen.
I think on canola, my understanding, and certainly that's one area, and I can't comment on Chinese law, but the current anti-dumping penalties that have been imposed on Canadian producers was meant as an interim measure on the understanding that the final decision would be made in March 2026. So what is likely to happen, and seemingly that's the message that's being sent now, is that instead of the current tariffs, which works out to approximately 85% overall on Canadian canola, that's going to be reduced down to 15% as of March 2026. So that is actually a very significant reduction. And just for context there, I think the current tariffs on Canadian canola oil and canola meals is at 100%, and I think on canola seed at 75%. So that is a rather significant adjustment, and I would certainly think that that is a positive development for Canada.
And with the Chinese EV side, what's it going to be like to try and bring these in? Do they pass all safety standards we have here? What kind of issues might we see? Could we see legal challenges against them?
I think that's a really good point, and I think Transport Canada historically has been obviously the regulators will ensure that all vehicles sold in this market will have to comply with Canadian legislation for safety standards and so forth. I think what needs to be noted is that the quantity that's being proposed, the 49,000 units, that is largely consistent with the pre-tariff number of units that were already imported into Canada from China. And a lot of people don't realize this. With globalization, there has been already a lot of manufacturing, automotive manufacturing and products that have made its way onto our shores. So this is not necessarily a complete revamp of that. It's a reintroduction of that relationship.
And we've heard from Ontario Premier Doug Ford lashing out at this, calling it a terrible deal, pretty much a sellout for the auto industry here. Could it lead to that? Could it lead to the Armageddon almost he says may happen?
You know, I think there are very legitimate concerns for the Canadian automotive sector. Historically, obviously, Canada's automotive manufacturing is closely tied to our American allies to the south. And really, in terms of numbers, the Canadian market is huge, of which a sizable chunk of that market is in the purchase of domestically manufactured vehicles. I think last year, Canadian sales, vehicle sales, light-duty vehicle sales, was at 1.9 million approximately. So what's being introduced will have an impact, but it is somewhat modest because 49,000 units as a reflection percentage of that is minuscule. It's less than 3%. So I think it is a change in the marketplace, but it is being introduced in a fashion that is, as we had expected, limited and certainly conditional, and limited in the sense by the operation of those quotas. And conditional, of course, is the trade side where Canada is getting the benefit of access to the agricultural market. And I think it is really a balance of that. It's not so much a discussion of factories or farmers, it is both. It is finding the right balance. And I think the Prime Minister and his team seemingly have done much of that on this trip.
Okay, we have to wrap it up there, Derek, but thanks as always for joining us.
Great, thank you.
Derek Young is a partner at Gowling WLG. Coming up, we'll get more on how the Chinese EVs will impact Canadian consumers. That's after the break. Of course, the big story today, Canada's new trade deal with China. The news came down this morning. Prime Minister Mark Carney saying that up to 49,000 Chinese electric vehicles will be allowed into the country each year with a tariff of about 6%. For more on how this will impact the average Canadian car buyer, I'm joined by Daniel Breton, President and CEO of Electric Mobility Canada. Daniel, thank you very much for joining us.
My pleasure.
Initial reaction to 49,000, a small amount. What kind of an impact do you think this will have on the market for EVs in Canada?
I think it will make a difference because right now there's a big issue with affordability when it comes both to new electric and gas cars, actually. When they're talking about providing the very low 6.1% tariff instead of the 106% tariff for cars that could be below $35,000. considering that there are very few gas vehicles below $35,000 nowadays, I think it will make a difference, and I think it will put pressure on other car makers to come up with affordable cars.
Now, I mean, as long as they're being manufactured in China, they'll probably stay this cheap. But can American and Canadian car companies compete with that? Because we have different laws when it comes to salary and pay and things like that just naturally drive up the cost of a vehicle.
Well, funny you should mention that, because right now I'm in Paris as we speak, and I'm testing electric cars made in Europe below $35,000. So it is possible. It doesn't mean that it will necessarily come from Canada or come from the U.S., but what's happening right now with the U.S. is disturbing, to say the least. I mean, a few days ago, the President of the United States basically said, we don't want any cars made in Canada to be sold in the U.S. So what that means is that he's threatening the Canadian auto industry as a whole. So I think the timing for Prime Minister Carney is perfect, because it means we have to find new partners to work with, whether it's from China, Japan, South Korea, or Europe. So yeah, I mean, we have been very, very codependent with the U.S. for 60 years with the Auto Pact, but now things are changing, and they're changing quickly. So I think that this 49,000 electric cars coming to Canada is a first step in the right direction. What I'm really interested in now is to hear more about the co-enterprises that should be put together between now and the next couple of years, meaning that Chinese companies and Canadian companies would come to Canada and work on developing an EV supply chain, which I think is very important.
Could you see this actually become a Canadian EV manufacturing where we make our own EVs?
Possibly, or at least components of EVs. We're talking about the Arrow project. That could be a possibility. So that's why we have to look at this from a consumer point of view as good news, but it's as you said, it's less than 3% of all light-duty vehicle sales in the country. So this is not going to change things that significantly, but I think that, like many other things, we have to look at this as an opportunity to do better business and to find new partners. Because right now, obviously, the President of the United States is not a reliable partner. I mean, he even said that he didn't care about CUSMA. So what do we do from here? So that's why I applaud Prime Minister Carney's move, because we have to work around the U.S. That's where we are.
All right,
And keep in mind that when we're talking about cars manufactured in China, it doesn't necessarily mean cars manufactured in China by Chinese automakers. These cars could be GM or Toyota or Nissan or Tesla made in China. I'll give you an example. In Mexico, you can buy a Chevrolet Spark EV, which is made in China, which is sold in Mexico, which we can have access to. So maybe GM will bring these cars to Canada, and these are affordable electric cars.
How did the Chinese EV sales do in Canada before the tariff? And do you think will people want to buy these Chinese EVs? I mean, they're cheap for sure.
That's a great question, because before the 100% tariffs back from September 2024, the electric cars that were sold in Canada were not entry-level electric cars. They were Volvos and Polestars and some Teslas, meaning that they were $55,000, $65,000, $75,000, $85,000, $100,000 cars. So people need to understand that it's not because it's Chinese that it's necessarily going to be affordable. So the purpose of the announcement was to make sure that we do get those more affordable electric cars from China. And I think that's very important.
All right, we have to wrap it up there, and we'll let you get back to driving through the streets of Paris. It's not a bad place to be testing vehicles. Daniel, thank you very much for joining us.
My pleasure.
Daniel Breton is President and CEO of Electric Mobility Canada. Up next, we'll bring you a labor perspective on Prime Minister Carney's deal with China. Stay with us. Let's get another perspective on Prime Minister Carney's deal with China. We're joined now by Lana Payne, National President of Unifor. Lana, thank you very much for joining us.
Thanks for having me, Roger.
Your reaction to this deal. Let's get that going right now.
Oh, it's very, very risky and very, very worrisome for the auto sector and for auto workers in our country right now. As you know, and as your listeners know, we are in the fight of our lives to save good auto jobs in Canada, and opening the doors to cheap Chinese imports is just going to make this even harder.
And what are your concerns with that? With the that they'll be able to flood the market right now? It's only 49,000 vehicles that would be coming in, which is 1 to 2%, 3% of the total market. What's your concern with that?
Obviously, that's what it is right now, but my understanding of the deal is there's an escalator built in annually around that, so the quota will go up. The reality is this is what China does all around the world, and if we look at countries where, they've had a foothold, if it's Brazil, if it's Europe, if it's Germany, the domestic auto industry has suffered as a result, and we're at risk of that here. The fact is, it is very, very problematic, and very, very problematic at the time in which we're trying to stabilize this industry in Canada because of what we're facing south of the border. I'm also concerned about what impact this will have on the CUSMA review. And that's the trade agreement review, obviously. Yeah,
and I want to talk about that. But there has been talk with China that we'll see maybe some production or some Canadian connections with everything. Is there any optimism for that, do you feel?
Honestly, that is what I'm hearing is that's like 2-3 many years down the road. And we have a problem right now to save our auto industry. And we don't know what that's going to look like. What I see built into this deal is an ability to come back to Canada within a year to say, okay, now we need to renegotiate what happens with seafood. There is only a temporary reprieve there for the seafood industry, where we also have members. This is problematic in so many ways. And I know our auto members are looking at this. I met with them this morning with our leadership. There is a lot of concern across the unionized auto sector in Canada right now.
Why do you think Carney made this deal then?
You'll have to ask him that. I can only suppose that they're trying to diversify with countries around the world. But this is in my mind, we're in a place where we need to make good decisions for the Canadian auto sector, and I don't believe that this is one of them.
And now you mentioned about CUSMA. President Trump has been remarkably silent on truth. We've heard nothing from him yet about this. I would have thought we might have heard something from him about this. What are your concerns about this deal impacting CUSMA?
I mean, the day is young on that front. Anything could happen before evening. I think the reality is that it was going to be tough enough to get a CUSMA deal. The Americans have been very clear about their position on China. We build cars together. The fact of the matter is, by increasing the number of imports into North America, which this deal does, even at the start being a small number, it will grow. But increasing the imports into North America by countries or companies that virtually do nothing, have no footprint, have no supply chain, and build nothing in North America continues to be a problem. And all we saw today was a growth in that problem.
Now the one person really not being talked about in this, I guess, is a consumer. An opportunity at a cheaper option for transportation is always welcome. What do you say to them that you don't want to see them maybe get a deal on have a little more money? running around?
I mean, the reality is that we need to be able to build more affordable cars in Canada. That is true. But also, I think Canadians understand that we need to have a vibrant, robust auto sector in this country. It is the foundation and the basis of an advanced manufacturing sector. And without it, we have a very big problem throughout the industrial economy of Canada. It impacts our steel industry. It impacts our aluminum industry. It is far-reaching, and that's why we have to do everything possible today to protect what we have, so that we have an industry tomorrow and for generations to come.
So why do we not have a cheaper option for people?
Well, I mean, we were in the process of getting there, and obviously the changes in what's been happening in the United States around the EV front, all of that is playing into this moment. But that doesn't make this any easier. And we have two competing kind of things happening here. We need to be able to have a strong industrial strategy for Canada around the auto sector, but that can't be that only a consumer strategy. We have to also build here. So, you know, that's the reality. And if we're going to sacrifice one for the other, we're not going to have an auto industry in this country.
And we're almost out of time, but do you see yourself trying to launch any legal challenges to this?
I mean, I'm going to be as forceful as I can be and continue to be with the federal government, with the provincial government, with everyone that we need to be in terms of what we need to do to protect good jobs in the auto sector, in the seafood sector, but throughout the country in terms of our industrial economy. Our union's been a leading voice on this, and we're going to continue to be.
Okay, we have to wrap it up there, but Lana, thank you for joining us.
Thank you very much.
Lana Payne is the national president for Unifor. And thank you for watching Morning Markets. That is it for me. We'll see you back here on Monday.